Alright guys, my name is Shervin, welcome to my channel. In this video, we're going to talk about everything that you need to know about investing into the stock market in 2023. Now 2022 was a wild year. It was a year where the S&P 500 entered into a bear market and even finished the year almost 20% down from the beginning of 2022. And now going into the new year, the question on every investor's mind is how is the stock market going to shake out in 2023? And especially with a potential recession on the horizon and dwindling market values all throughout last year, it's fair to say most investors aren't so confident about a market bounce back in 2023. But of course, you're not here to see what the average investor is thinking. You're here to get information from the experts. And if you watch to the end, you're going to find out exactly what the largest banks are forecasting for the stock market in 2023, what experts recommend you do in the meantime, and how you can use the current slump to make money. And all that I ask from you guys is that if you are new to my channel and you enjoy this video, make sure to smash the subscribe button down below and join the community. I make new videos about personal finance and investing on a regular basis. And by subscribing to the channel, you get to see all my new videos right as they come out. Also, if you enjoy the video and you appreciate all the research that I do in these videos to get you the best information possible, then do me a favor and smash the like button down below for the YouTube algorithm. But alright, with all that said, let's get right into it. Now first, we're going to start by looking at some of the most notable forecasts for the stock market in 2023, and we're going to start with J.P.Morgan. Now to summarize, J.P.Morgan predicts that there is going to be high market volatility throughout the year. They predict that the S&P 500 is going to have a slump in the beginning of the year, and then it's going to rally at the end of the year. Where they predict that the S&P 500 is going to end the year at around $4,200 a year, which would be about a 9.5% growth from where it ended this year. So overall, J.P.Morgan has a positive outlook, and even though they don't see the market fully recovering, it is still a step towards the right direction. Now, Bank of America is more or less on the same page as J.P.Morgan, where they predict that the beginning of the year there is going to be a recession and a huge shock to the market, and then they forecast that in the second half of the year the S&P 500 is going to enter into a bull market. So essentially, Bank of America is predicting a similar trend to J.P.Morgan, it's just that they're more extreme on both ends. But interestingly enough, not everyone agrees with this sentiment, as Morgan Stanley has a very different outlook on how the year is going to go. Now, they forecast that the S&P 500 is going to drop a further 15 to 20% throughout the year, but they also predict that there is going to be a recovery at the end of the year, where they predict that the S&P 500 is going to finish around the same place that it is right now. So basically, they predict almost no growth or decline for the S&P 500 at the end of the year. Now, the Jefferies group, on the other hand, have very similar forecasts to J.P.Morgan, where they also see the S&P 500 closing out the year at around $4,200, which again would be about a 9.5% growth from where it ended in 2022. Now, what is one meant to make of all these different forecasts that each have their own point of view on how the market is going to behave in the coming year? Because again, these are all large financial institutions that all have a lot of smart people working for them. So how is the average investor going to figure out which one of these forecasts is more reliable? Well, the answer to that is very simple, and that is that any short-term forecast for the market is almost always not reliable. Take 2022 as an example. Almost every single one of these banks predicted massive growth for the S&P 500 by the end of the year. And of course, as we now know, they were all completely wrong, as the S&P 500 fell almost 20%. So where does that leave us? What are the investors supposed to do if they can't really rely on any of these forecasts all that much? Well, as this article in the New York Times points out, you should be more worried about how the stock market is going to behave in the next 10 years instead of just the next year. Because unlike these short-term predictions, the long-term forecasts of broad index funds are much more reliable. In fact, if you look through all of recorded history, there is no 20-year period where the value of the S&P 500 did not go up. And even though it is true that past performance doesn't necessarily guarantee future results, there is a reason why the S&P 500 has been so consistent over the long term. And that is because it is extremely diverse and a good representation of the best of the US economy. Because again, the S&P 500 is a collection of the top 500 companies in the United States. And by investing into this index fund, you're essentially investing into the best of the best. And as long as you are investing into index fund for the long term and you make sure you buy and hold and never panic sell, it is very unlikely for your investments to not experience growth over the long term. Now, of course, since you can't really predict what is going to happen in the short term, it is impossible to time the market perfectly, which is why the best way to invest into index funds for the long term is dollar cost averaging. And using this method basically means that instead of investing, let's say $50 to $100 once a year, you invest $100 once a week. That is because by investing every single week, you're averaging out how much it costs for you to invest into that particular index fund. So that over the whole year, you end up averaging out how much one share of that investment costs you. And by doing this, you always get a good deal. Whereas if you just invest all of it at once, one time in the year, there's no way to know if you could have got a better deal or not. At least not until it's way too late. So if you are wondering how you should approach investing in 2023, given all the potential volatility, let me just say that you can't go wrong with investing into broad index funds and investing for the long term by dollar cost averaging on a regular basis. And also make sure not to panic sell your long-term investments when the market is down, because again, remember, you don't lose money until the moment that you actually sell for less than you bought it. So don't panic, keep your wits about you, and have a wonderful new year. Now that's about it for this video. Hopefully you guys enjoyed that. If you want to get regular updates about the stock market from me, make sure to follow me on Twitter at Shervin. Also, if you haven't done so already, make sure to smash the subscribe button down below and join the community. And also feel free to follow me on Instagram. I post there regularly, so if you want to be a part of it there, make sure to follow me there. Also, as always, if you have any questions about any of the stuff that we talked about in this video, make sure to let me know in the comments down below. I always respond to every single question that comes in. And now with all that said, thank you guys so much for watching, and I will see you in the next video. Cheers.